What is a portfolio company in private equity? Private equity funds and companies they own are structured in different ways than you might be used to. In this video, I'm going to teach you PE 101, and you won't even have to do a single push-up or run a lap, well, unless you want to. All right, so first, what is a portfolio company? Well, simply put, a portfolio company of a private equity fund is a company that the fund owns or has invested in. For private equity funds that are leveraged buyout funds, usually this means that they have bought the company in its entirety, right? They've used some equity and some debt to buy the entire company, and then that company, they hold it, they control it, and then when they're ready to sell it, they sell it to another private equity firm or to another strategic, or maybe they take it public, and that's how they generate their returns. In private equity, these companies, like I said, are controlled by the private equity fund. So oftentimes, the private equity investors will sit on the board and they control the board. They will also control major investment decisions. And that's why a lot of private equity funds, when they acquire these businesses, are cutting costs, right? They may lay off a bunch of people. They may decide to move manufacturing from the US to a developing market where cost of labor is cheaper. They are doing a bunch of these things to drive additional value or to drive additional profits out of the company. They may also do what's called a roll-up strategy. So in that case, they're not just buying the company. They might buy a company that they're really excited about that is very large, and then they'll look for other smaller businesses to do the same thing to buy on and roll in or bolt on to that larger company. So in that case, when they buy that other company, it doesn't really become a portfolio company, and rather it's merged into the portfolio company. So not all companies that private equity firms acquire are portfolio companies, but they may have large companies that reside within the overall portfolio as they're adding on more companies to that larger company. And then in that case, they just get merged in and become part of the underlying portfolio company. So how are deals structured? Well, like I said, private equity funds, buyout funds, use leverage or debt to buy the companies. This is very similar to if you were to buy a rental property as an investment. Most of the time, you wouldn't go and put down all your cash on the property and buy it out with all cash. Usually, you're going to borrow some money to buy the property. It's the same thing with private equity funds. The difference is that when I buy an investment property as a rental, I might be putting down, 30, 40% of the cash and borrowing 60, 70, maybe upwards of 80% of the cash on that transaction. In private equity, it's a little more nuanced because the amount of money that they borrow is based on the cash flows of the business. And that's because banks want to underwrite their loan relative to the amount of profits or cash that a company is producing. So if you have a company that produces very high profits or high cash, then they're able to borrow a lot more money than those that are generating less cash, if that makes sense. Regardless of how much revenue they're generating, how many employees they have, et cetera, et cetera. Banks care a lot about this metric called EBITDA, which is earnings before interest, taxes, depreciation, and amortization. And really, it's a representation of the cash that a company is generating that can be used to pay off debts and so forth. So, as private equity investors, you can borrow a certain number of what they call turns on EBITDA, right? So the typical is somewhere between probably 4 and maybe upwards of 10 times EBITDA or turns on EBITDA. So if a company is generating $10 million of EBITDA, then they could borrow anywhere between $40 and $100 million worth of loans from the bank. That then gets used by the private equity firm to buy the company. Oftentimes, what that ultimately ends up being is that the private equity company is kicking in 40 to 50%, call it, in cash, and then borrowing the other 40 to 60% in debt. Then they use the cash from the business to pay down the debt. Now, there are a lot of different ways that private equity funds can make money off of this. If the business doesn't grow at all and just maintains steady, flat cash flows and steady, flat revenues, then all they have to do is pay down the debt, and they will go from owning, call it 40% of the business to owning 100% of the business and generating at 2.5 times their investment. Very low risk, and you're just using financial engineering essentially to generate those returns. Another way that you could do it is by actually improving the business. So getting in and either growing your top line revenue and keeping your margin profile the same, thereby generating more profits, or getting in and making cuts where necessary to drive more profits. So a good example of that is Bell Helmet. So there was a private equity fund that bought Bell Helmet. Bell Helmet at the time, right, they make the bicycle helmets. They were doing all their manufacturing in the US. The private equity fund took that, they moved it over to Asia and had them manufactured there and cut their costs by quite a bit. That generated more profits for them, and they were able to use that to pay down their debt faster, right? Classic way for private equity firms to make money. They also can make money in a couple other ways beyond just debt repayment and improving margins. They can do what's called dividend recaps. So the way that works is the company is paying down the debt. The private equity firm's not quite ready to sell the business yet. And so what they do instead is they go back to the bank and they say, hey, you know how we borrowed like $100 million? Well, we've now paid off like 80 million of it. We would like to borrow another $80 million because the business is doing just as well as it was before, maybe even a little bit better under our stewardship. And so the bank says, okay, yeah, we'll lend you another $80 million. And so they take that $80 million that's new cash on the balance sheet of the company and they dividend it out as profits to the private equity firm. So what that allows private equity firms to do is the company's paying down the debt, pay down the debt. Then they do a dividend recap and they borrow a bunch more money. They dividend that out to the investors, and then the company pays down the debt, and they could do it again. They could do it 1, 2, 3, 4, 5 times, however much they want, until they get to a point where they're ready to sell the business to somebody else and lock in the remaining returns. The other way that they can make money is off of what's called management fees. Although this is a somewhat controversial way to generate additional income. Basically what they do is they say, hey, I'm the one taking the board seat, and most people that take board seats get compensated for that. And so we're going to charge essentially a fee to the company in exchange for the excellent management that we are providing to that company, right? So that could be another way for them to pull out cash from the business. But it is a little bit controversial because investors in those private equity firms may look at that and say, hey, you know, that's really not indicative of like how the business is doing. And you're essentially like adding an additional expense when what you really should be doing is paying down debt. So a little bit controversial, but very common nonetheless. Ultimately, private equity, therefore, can be super lucrative. Think about it this way. Let's say I buy a business for $100 million and I put in, just to keep the math simple, $33 million, and I borrow the other $67 million. The company is generating like $10 million in cash flow every year. And I get in and make some changes and I'm able to improve the profits from $10 million to $20 million. Maybe the prior owner like had a private jet that he was flying around and causing additional needless expense on the business, and I just get rid of that. So now I'm generating $20 million in this company, and I'm using that to pay down the $67 million. Well, over the course of 3.5 years, I pay down all of that debt. I now own 100% of the business, and I've also improved the profits, which means this business is worth quite a bit more to somebody else. Maybe they're now willing to pay $200 million because I increased the cash flows of the business by such a large amount, by 100%, right? So now I sell the business to them for $200 million. If you remember, I put in $33 million, and now I just sold it for $200 million, and I get all $200 million back, giving me an effective 6 times my investment. And that could happen in like 3 years, which would represent a very, very strong return. And you can do it at like huge numbers, right? So if you look at big funds like Bain Capital, right? They manage tens of billions of dollars and aren't doing this at the $100 million level. They're doing it at the multi-billion-dollar level, which means when they generate a return on a $20 billion fund, their carry, right? The amount of money that the partners at the fund get paid of the profits of their investments can literally be in the billions of dollars. So remember, what is a portfolio company in private equity? It's the company that's owned by the private equity firm, and the big driver in terms of how private equity firms generate returns for their investors. Hopefully this is helpful. If you want to learn more about venture capital, check out my next video where we're going to talk about how to get into venture capital without any experience.